In a landmark move with potentially transformative implications for global economic development, Jamie Dimon, Chief Executive Officer of JPMorgan Chase and Company, convened with top executives from the World Bank Group and several other multilateral development banks. The purpose of their gathering was to explore strategies to enhance the flow of private capital into emerging markets, a sector that is crucial yet underfunded. This significant meeting took place during a private luncheon hosted by JP Morgan on the sidelines of the International Monetary Fund and World Bank's spring meetings in Washington, D.C. The agenda was ambitious and clear. Dimon and the development bank leaders discussed how to leverage private sector involvement to fill the vast financial gaps in global development funding, particularly in less economically developed countries. They examined several strategies, including the creation of risk-sharing financial instruments and the facilitation of access to private debt markets through bond issuances. These financial tools are designed to make investments in high-risk regions more attractive to private investors by offering mechanisms to mitigate potential losses. An important backdrop to these discussions is the increasing influence of China as a major creditor to emerging markets. The U.S. and its allies are acutely aware of the strategic implications of China's growing financial dominance in these regions and are keen on developing alternative funding sources to enhance their own geopolitical and economic influence. This makes the participation of a high-profile financial leader like Jamie Dimon not just newsworthy, but also a strategic signal of the heightened interest of Western private sectors in development finance. Remy Rieu, head of the French Development Agency, underscored the unprecedented nature of Dimon's involvement, which marked a culmination of decades of efforts to draw top-tier finance executives into the fold of international development finance. The discussions also highlighted the broader economic and social impacts of engaging private capital in development finance. This includes potential advancements in infrastructure, healthcare, and education, as well as significant contributions toward climate resilience and sustainable growth in emerging markets. The challenges, however, are substantial. Historically, private investors have shied away from development projects in emerging markets due to their high-risk nature and the often low returns on investment. To address these concerns, the meeting explored not only financial instruments, but also the need for political and economic stability in these regions, which can further reassure investors. Furthermore, the focus on climate-related projects reflects a shared understanding of the urgent need for substantial investment in sustainable infrastructure to combat global warming, a task that far exceeds the current funding capabilities of traditional development finance institutions. These initiatives are seen as essential for ensuring that developing countries can pursue economic growth without exacerbating environmental issues. The implications of this meeting extend beyond immediate financial commitments. By potentially increasing private investment in development projects, there could be a shift toward a more integrated approach where global financial markets are leveraged to address economic disparities and promote global stability. This approach could foster a new era of global cooperation, where finance and development are not seen as separate spheres, but as interconnected elements vital for the prosperity and health of the global economy. Looking forward, the success of these initiatives will hinge on the ability of these financial leaders to translate their discussions into actionable strategies that result in tangible investments. This will require continuous engagement, innovative thinking, and rigorous oversight to ensure that the investments not only yield financial returns, but also contribute meaningfully to the development goals of emerging economies. The path forward is fraught with complexities, but the potential benefits for global development and economic stability could be profound.